Hello, ladies and gentlemen, and welcome to EQUATE Group's earnings webcast for the first half of the 2020 financial year. Today's webcast is being recorded. Please note that the historical and current performance data in this presentation are not necessarily indicative of future performance. I am Wael Allahu, and I will be your moderator for this webcast. I am joined today by our President and CEO, Dr. Ramesh Ramachandran, CEO-elect and Senior Vice President, Mr. Nasser Al-Dosiri, Chief Financial Officer, Mr. Dawood Al-Abdul Jalil, and Vice President Operations, Mr. Gonzalo Beltran. This webcast will be followed by a Q&A session. At any time during the webcast, you may submit your questions through the Ask a Question tab. We expect this webcast to conclude in 30 to 40 minutes. After this call, the webcast and presentation will be available for replay at your convenience through this same link. Both the presentation and webcast will also be shared on our website under the Investor Relations section. With that, we will now start with Dr. Ramesh Ramachandran.
Thank you, Wael. Hello, everyone, and thank you for joining us today. On behalf of the entire EQUATE Group, I hope you and your families are staying healthy and safe. And a very special thanks for being part of the EQUATE investor family and your confidence in this great company. As you might have seen, let me start by highlighting some management changes that are going to occur rather quickly. Firstly, which we have already announced in public. I would like to take this opportunity to introduce Mr. Nasser Al-Dosiri, who is currently the Senior VP of EQUATE Group, as the new CEO of Greater EQUATE, effective October 1, 2020, and also welcome two senior team leaders who will join the executive management team of EQUATE. As Senior VP, Mr. Sudhir Shenoy will assume his responsibilities on October 1st, 2020, and our new CFO will be Mr. Fisanu Samchai-Wong. So this will be my last quarterly update with all of you. I wish everybody all the best in their new roles. At EQUATE, back to business here now, we are committed to keeping our DCM investors informed and updated with the latest information. So today's presentation will start with an overview of the global markets, EQUATE Group's financial performance in the first half of the year. We will follow that with a detailed financial review of our cash flow and profitability by our CFO, provide some business and market highlights by our CEO-elect and Senior VP, Nasser, safety and sustainability updates by our VP of Operations, and lastly, a Q&A session where we can address your questions. As you're aware, as a summary, the EQUATE Group is a joint venture between PIC, or Petrochemical Industries Company, and Dow, with each holding about 42.5% of the group. PIC, as a lot of you know, is a subsidiary of KPC, which is what gives you an exposure, a substantial exposure to the sovereign of the country of Kuwait. And Greater EQUATE, as some of you might know, is about 60% of the non-oil exports of the country of Kuwait. So that is how significant an entity EQUATE is with its Kuwaiti assets. Smaller shareholders are Bubian Petrochemical, that owns 9%, and Kurain Petrochemical, that owns 6%, both of which are listed in the Kuwaiti Stock Exchange. When we refer to the EQUATE Group, we are speaking of EQUATE Petrochemical Company and its subsidiaries, as well as TKOC. Moving to slide 6, if we were to summarize what we have done so far in 2020, EQUATE Group remains the leading low-cost producer of all its products across the world because we are an ethane-based producer, and 100% of our products through the year, despite these headwinds, have been sold out globally because demand has been resilient and we are the low-cost producer, so we are obviously going to maximize our earnings with volume. Another major highlight, of course, is that our U.S. Gulf Coast plant that came into operations a lot sooner than expected is already producing product at 15% above its nameplate capacity. Despite these significant global headwinds and announcements from our peer groups on how hard it has been to be in this industry this first 6 months, our EBITDA margins are about 29% of sales due to our aggressive cost control measures and market-leading positions across the globe. EQUATE will remain an extraordinarily resilient company despite all these headwinds, and we will provide more details through the presentation. Moving to slide 7, let me provide you with a brief overview of the group on our global presence and our product portfolio. Our industrial complexes are located in Kuwait, Germany, and North America. In North America, our assets, of course, are in Canada, in Alberta, and in the U.S. Gulf Coast in Oyster Creek. Our total EG production capacity has reached about 3.2 million tons and continues to grow due to our debottlenecking efforts with our new EG plant on the U.S. Gulf Coast. Our EG sales breakdown in the first half of 2020, 35% came from Kuwait, 34% from Canada, 24% from our new asset in the U.S., and 7% from other regions. Our Kuwait complex mainly serves our EG customers in Asia, the Middle East, Turkey, and the Indian subcontinent. Our facilities in North America serve customers in North and South America as well as Asia. The strategy, of course, is to maximize net back earnings, so we optimize supply chain costs because of our global presence. Polyethylene, our entire portfolio, is produced 100% in Kuwait and supplies customers in North Asia, Indian subcontinent, Europe, Southeast Asia, Middle East, Turkey, and Africa. PET, which is the raw material that goes into bottled water, is produced in Germany to primarily serve the European customers. Moving to slide 8, EQUATE Group maintains its leadership position as the second largest producer of ethylene glycol globally. Our sales is widely distributed across various regions, with North Asia representing the biggest market because that's where most of the polyester is manufactured for the world today, followed by the Americas at 18%, the Indian subcontinent at 11%, Europe at 9%, and the rest of the world representing 5%. If you go to slide 9, we share our polyethylene sales by region, where we sold 47% to North Asia, 24% to the Middle East, Turkey, and Asia, 17% to Southeast Asia, 6% to Europe, and 6% to the Indian subcontinent. Bottom line, broadly distributed across the world to take care of any risks that might be associated with either credit or markets. But most of the products today are re-exported after being manufactured in the North Asia, South Asia region, and we expect that trend to continue. Going to slide 10 for EQUATE Group's financial results highlights. We closed the first half of the year with good profitability, but understandably much below our historical results due to primarily the COVID crisis and some supply increases. But overall, as I said before, we haven't seen any drop-off in demand. The industry is navigating a challenging business environment. Our margins, of course, primarily capitalize on the gas to naphtha spread because we are completely based on ethane across the world. That's how our ethylene assets are based. And so as oil prices go down, we experience margin compression. The reported results of the first half of 2020 reflect the combined results of the EQUATE Group, which consists of EQUATE and its subsidiaries. As you see, our revenue was down 17%, mainly due to pressure on prices, and we will discuss more about this in the slides ahead. EBITDA was $409 million, down by 22% from the first half of 2019, even though sales volume increased by 15%, which gives you an idea on the magnitude of the impact of lower prices. Combined net income was $124 million, which was 60% less than the same period last year, and Dawood can give you the explanation because there were some one-off costs related to refinancing that occurred in the early part of this year. The group's new U.S. Gulf Coast plant started production in October 2019, and accordingly, there have been some depreciation and amortization charges that will be further explained as I hand it over to Dawood. So with that, let me hand over the presentation to our CFO, Dawood Abdul Jalil, who will speak about our financial position and our cash position.
Hi, everybody, and thank you, Ramesh. In the next couple slides, I will take you through our financial result for the first half of the year. In slide 12, let's have a look at our financial position as we ended the first half of the year with $460 million cash on hand. Our gross debt stood at $4.65 billion. This resulted in a net debt position of $4.19 billion. Our EBITDA was $409 million. Going to slide 13. Here we can see in your left side the table of our cash flow and liquidity position in the first half of the year. We started the period with beginning of $802 million cash on hand, and we had $73 million cash flow from operating activities. We had $11 million cash flow used in investing activities, and we have $146 million cash flow used in financing activity. And we distributed $382 million as dividend paid in quarter two, which represents 60% of 2019 return earning. And we ended the period with total cash in hand of $460 million. If we see the right table, the debt position, and in order to effectively manage debt liability, during second quarter, we successfully completed a $1.6 billion tranches issuance and secured $300 million with Kuwaiti local banks for a tenor of 3 years to refinance the $1.9 billion banks loan we had. In an effort to optimize cost, we managed to reduce the RCF commitment by $500 billion to be at $425 million throughout strong relationship with banks, which in return led to a reduce the annual commitment fees by 50% and extend the facility by a year to June 23rd, 2021. The EQUATE Group has a well-balanced debt maturity profile, reduced cost, and providing stability amidst current market condition. As you can see, the next debt maturity will be in March 2022. Going to slide 14. Our EBITDA margin was still at a healthy level, exceeding 29%. This is a true reflection of our low and competitive cost structure, together with our operational excellence, high asset utilization, and effective cost management. EQUATE Group sales revenue reached 1.4 billion compared with 1.7 billion same period last year. EBITDA went down from 526 million in first half in 2019 to 409 million first half 2020. Finally, our net income stood at 124 million in first half 2020 compared to 308 billion during first quarter 2019. Going to slide 15. Looking at the revenue in more details, EQUATE Group maintained positive financial and operational performance as evidenced by several metrics. We recorded a total revenue of over 1.4 billion, down by 17%. We generated 45% of our revenue from North Asia region, 18% from Europe, 11% from Americas, 8% from the Indian subcontinent, and 18% from the rest of the world. From a revenue by product standpoint, 61% of our revenue is generated from ethylene glycol, 22% is from PE, 10% is from PET, while the remaining 7% is from other sources of revenue such as services. Let's take a closer look into our volume and average prices for the first half of the year. From an EG side, we are looking at a sales volume of approximately 2 million metric ton, which is 19% higher than last year at an average price of $438 per metric ton, 26% less than what we had in first half of last year. From the PE side, we sold 402,000 metric ton, which is 4% higher than last year at an average price of $777 per metric ton, which was down by 26% from what we had in the same period last year. Finally, PET volume was 162,000 metric ton at an average price of $858 per metric ton, a 30% lower than what we had last year in first half. From here, I would like to introduce our CEO, elected and Senior VP, Nasser Al-Dosari.
Thank you, Dawood. Greetings, everyone. Moving to the market update on slide 17. Despite significant headwinds in the global markets, EQUATE Group successfully continues its sold-out position, maintaining to run operation at a flat-out rate throughout the period. Customer allocations continues to be strong in a resilient market, with continuous netback optimization that is supported by our global integrated supply chain. All our production and additional amounts in the glycol side are placed in our markets successfully. Moving to the market and price trends of our product on slide 18. The market is experiencing a trough that has been impacting the pricing on EG and PE. More onto the supply side, we've seen more volume throughout the recent period. Average prices have fluctuated since the beginning of the year when compared to rates in 2019. Headwinds started year-end 2019 and continues as we speak. At the same time, demand was impacted by ongoing geopolitical uncertainty, but EQUATE Group continues to capitalize on all suitable opportunities to optimize its operation and servicing our customers in the best way possible, leveraging our geographically diverse, cost-competitive plants across the 3 sites. The group was able to navigate through this period and remain disciplined, maintaining our market position. We're also confident that the group can maintain its profitability and overall stability by leveraging sizable, low-cost competitive production capacity, high asset utilization, and a global distribution platform. We can't underestimate the challenges that our industry may have to face, but effective management, as we've demonstrated in the first half of the year, weathering the most challenging of circumstances, and we are prepared and ready and able to continue to manufacture and deliver our products to our customers effectively. Thank you for your attention on our market overview. Now I would like to hand it over to our VP Operation, Gonzalo Beltran.
Thank you, Nasser, and hello to everybody. On slide 20, as we can see, all facilities around the world continue to operate safely despite several external challenges, notably the global COVID-19 pandemic. I would like to take this opportunity to say that I'm very proud of EQUATE Group's achievement in maintaining high standards. We ensure that EH&S, reliability, and efficiency are seamlessly integrated across all our industrial complexes in Kuwait, Germany, and North America. We ran our plants at full capacity again this year, with asset mechanical reliability and production standing at around 100% of our plants. We have achieved over 24 million consecutive safe work hours without a day away from work. Our current recordable injury rate is 0. Also, we have had 0 process safety or loss of containment events, 0 motor vehicles, and 0 knowledge of violation from regulatory bodies. And obviously, we are in full compliance with all environmental regulations. Moving to slide 21. Our EQUATE Group continues to strengthen its commitment to sustainability. EQUATE Sustainability Strategy 2025 consists of 16 initiatives identified under 3 core themes: build, innovate, and impact, and is mapped against the United Nations Sustainable Development Goals. In recognition of the group's focus on prioritizing safety and the environment, EQUATE is Kuwait's first responsible care accredited and certified organization, the International Voluntary Initiative of the global chemistry industry to safely handle products throughout all phases. With that, I would like to hand it back to Wael Alahu, who will moderate the Q&A session.
I thank our speakers for their presentations, and we will now take your questions. You may continue to submit your questions through the Ask a Question tab during the Q&A session. Please give us a minute to go through the questions. Okay, we are back with the first question from Raul Bat. Do you plan to pay a dividend in second half? Is it fair to assume this lower 60% payout ratio as long as net leverage remains above 3x? Are ethane prices in Kuwait linked to oil prices? Why was capex so low in the first half? Is FX capex still expected at 140 to 150 million? Are the Canadians debottlenecking operation still planned, or has it been deferred?
Hi, this is Dawood. I will address the dividend, and our dividend policy is governed by our financial policy, and EQUATE shareholder and board always want to maintain investment grade, which translate into maintaining net debt to EBITDA at or below 3x over a cycle. Therefore, answering the question whether we will pay the rest of 40% of the dividend in second half or not, as I just mentioned, it could maintain its net debt to EBITDA at or below 3x over a cycle. And in regard of the capex, why, how much it will be? Is it 140, 150? I think we will close the year around 100 million as a capex within that range. And why we have a lower capex in the beginning of the year? We did defer couple of the activity from first half to second half.
Yeah, let me just build on that, Dawood, because there are a couple of questions that I see from, Amit and Jaskar, pretty much asking about the leverage and the, if we have a leverage target from Marco. I mean, the leverage target for investment grade is, of course, 3.2 or lower over the course of the cycle. And we have to keep saying over the course of the cycle, and we can get into the semantics of it, but I guess the best way for you to model us is 2 years ago, the leverage was as low as 1.8 or even lower, right, in 2018 during the commodity cycle. The shareholders are extraordinarily conservative, especially with, almost 42.5%, 60% being government entities in Kuwait. So we don't raise the dividend or do any special payout when the leverage is extremely low. At the same time, we don't completely stop paying dividends when the leverage is expected to be higher than 3.0 clearly during this year and probably even first quarter of next year. So it will vary. It is obviously a commodity. It's going to be a little cyclical, but it is a conservative company that takes its obligation as far as the dividend payment being only from net income. Don't forget, we are governed by Kuwaiti law. So it's not like simply because we have cash, we can pay out dividends. Our dividend is controlled by how much we generate from a net income standpoint. But over the course of the cycle, this will remain a pretty conservative company as far as its leverage ratio goes. And short term, let me preempt the question, there is no M&A or any such activity that is coming out. And I'm just looking at Frank Nowak's question. Yeah, if you look at it from a free cash flow standpoint, I don't know if that I'm sure it's already posted from a depreciation standpoint. If you look at our cash flow, it is a pretty strong cash flow generating machine. Yeah, depreciation alone is around $40 million a month. So if you look at that, over a period of 12 to 18 months, I mean, even at these extraordinarily low, historically low glycol prices of 460, 470, all the assets across the world are running flat out with a steady state glycol price of around, I don't know, even take a low number from historical average of 600 to 650, which is where I, think once demand returns to its normal heady trades comes back, we are back up to some extremely good numbers here. I'm just taking a pause here while looking at the question page, yeah? While we are waiting, let me provide some color also on the demand for the people on the call, because I don't think people fully appreciate the resilience of demand of glycol across the globe. Take a look at China, okay, where if you just read the news reports, especially as it relates to a variety of petrochemicals, people assume that demand must have collapsed and all kinds of interesting things must have happened. China added glycol capacity of close to 3 million tons in the 2019 first half of 2020 timeframe. Yeah, close to 3 to 3.5 million tons of capacity. If you look at glycol imports into China during that same time frame, nothing changed. If anything, it went up a little bit by about 2 to 3%, which is about 9 million tons of glycol. So over the last year, despite all these headwinds, Chinese demand for ethylene glycol increased by about 3 million tons off a baseline of give or take 15 to 16 million tons. That is a demand increase of almost 8 to 9% year over year during these times. That is how resilient this molecule is. There is a question on bond Sukuk supply to execute refinance on the 2022 maturity. I guess we'll decide in 2021, early 22, right? I mean,
yeah, I think it's too early now because the 2022 maturity, it will be our first 5-year bond of 1 billion. So as Ramesh said, it will be sometimes by end of 2021 or early 2022.
And Frank, on outlook, although we don't provide forward-looking outlook, what you can see from the performance and the resilience in the first half, weathering all the conditions and restrictions, movement across borders. This was happening mostly in the first half. In the second half, we're seeing the recovery signs and also ease across the globe. And we think that would also reflect on the market sentiment.
Ladies and gentlemen, we have not received any additional questions. We now conclude this webcast for EQUATE Group's first half 2020 earnings. The presentation and the webcast will be available on our website soon. Should you require further clarification, you may contact EQUATE Group's Investor Relations as per the information on our website at equate.com. On behalf of EQUATE Group, we thank you for joining our webcast today, and we wish that you all remain safe and healthy. Goodbye.